Hey everyone, Couch Investor back to another video for today. So as promised, a video on SoFi's current debacle, right? We had great earnings, stock went down. Then suddenly we have a bearish report with a $2.5 price target, making some claims. Again, bearish reports are always great to test out your own thesis and trying to debunk it and see if that analyst actually understands the business or not. Now, of course, the stock took a hit, recovered a little bit, and as always, when the stock takes a huge hit, what happens? Well, Anthony Noto buys more shares. In this case, 108,000 shares at $4.67. Now, of course, for those of you that have been following the company, he has been doing this when the stock takes a huge hit for no reason at all, so this comes at no surprise. Now, with regards to the analysts and new price targets, etc., let's start from the beginning. So on May 2nd, that same Wedbush analyst with the $2.50 price target already had a $5 price target and went from outperform to neutral. Now, he said the firm believes there could be downside risk to its gain on sale margins and fair value marks of its loan portfolio. There were minimal actual loan sales during Q1, but Wedbush fears that when SoFi does start selling loans again, there could be a material negative impact on the fair value of the loan portfolio. The firm believes that SoFi not selling loans in Q1 could imply that gain on sale margins aren't trending at similar elevated levels to those generated last year, or that the market for loans may have weakened. Then a couple of days later, we had an analyst at Truist who basically initiated coverage with a buy rating and a dollar price target. He sees SoFi as the future of US banking as it is digital, nimble, and always on. The company's key attributes include an appealing app, top-of-funnel products allowing members to get their money right, and a growing loan offering supported by leading underwriting. The firm sees the company's loan growth funded by bargaining deposits, suggesting years of above-average organic revenue growth at scale. And then more recently, we had that same Wedbush analyst cut SoFi to underperform as fair value accounting may present headwinds. And the note will pop up on the screen. And just as an FYI, this is the comparison between the Truist analyst and the Wedbush one. Now, in the meantime, we had an analyst at Mizuho basically also coming out to defend SoFi's case, says buy on the sell-off. Now, who has also been buying shares of SoFi? Well, that's the Vanguard Group. So they acquired another 1.9% more shares, which equates to 1.29 million shares. Now they have a total of over 69 million shares. Now, with regards to going against the bearish case, the Mizuho analyst actually is Dan Dolev. You might know him, covers Block, covers SoFi as well. So he came out and said this. We believe the correct reasoning is that SoFi is able to earn around 6.4% annualized yield on holding its personal loans, which is more attractive than selling them at around 5%. On the claim that holding more loans in the current climate could prompt regulators to ask the company for a more conservative approach to its accounting, he then said, "We argue that this is not even a possibility since regulators require that once you elect fair market value accounting, you maintain it through either the sale or life of the loan, even if you hold it to maturity." He also is unconcerned about the risk factor from SoFi's latest 10Q that could be spooking some on Wall Street. SoFi disclosed that if its current net losses continue for the foreseeable future and we are not able to achieve GAAP net income profitability in 2023 as currently expected, it may have to raise additional debt or equity capital, which may not be a favorable terms when compared to previous financing transactions. Now, of course, if you've been following the company for a while, you know that this is a statement that has been there for a while. This isn't something new. And then Dolev says, "We believe SoFi included this portion to emphasize its focus on achieving GAAP profitability by the fourth quarter." Now, with regards to a more broader answer, if you want, I'll link it down below from Brad Friedman in a Substack, Stock Market Nerd, made a great post to summarize it. Basically, he went against the claims, protected SoFi with some actually good and factual information. So it says here that SoFi is basically recommended to hold loans on its balance sheet instead of settling for approximately, like we said before, 4 to 5% gain on sales margin, as it could potentially earn around 8% gross spread. This recommendation is supported by SoFi's healthy credit quality, high income borrowers, and strong credit scores, as we've seen in the latest earnings report and as discussed in the earnings call. Despite expectations of credit deterioration and increased unemployment, SoFi believes holding loans is a responsible decision to maximize yield, given their excess liquidity, again something the CFO has said, and the ability to repurchase previously sold pools from capital markets. SoFi's growth potential would not be severely impacted if it reaches the upper limit of fair value marks. The company relies on a third-party firm to determine fair value based on expected cash flows. Loan classifications concerned are addressed, with the report stating that as long as loans are intended to be sold, they should be classified as held for sale. Even if there were to be a reclassification, it would not harm SoFi's operations or growth because of the excess liquidity and strong credit performance. The temporary hit to net income could be offset by continued high yields on the loan book, supporting long-term growth and mitigating the impact on book value. Also, remember, SoFi's outlook for this year is very, very pessimistic. In my opinion, they're way too pessimistic, and I think we're going to see the business perform much better than what they're guiding for. But of course, that's just me. Let's wait and see what happens. Now, quickly with regards to the graph, of course, when that report came out, we now have a small little gap here between $5 and the price we're at today, so $4.79 or so. But on that day, as I said, I think it declined around 10%, closed the day down 5%. So we got some bullish signs here that shareholders, investors do not want or will not allow this stock to go even lower. And then the next day, a red day, but we opened up a bit higher there. Overall, RSI not oversold, but in my opinion, pretty low now, 35. Of course, MACD still very, very bearish. So to conclude, when it comes to the bearish report, again, nothing really changes for me when it comes to SoFi. Time and time again, they prove they can execute. They prove they are great at managing the current situation. And let's be honest, this bearish report was another, in my opinion, nothing burger. Of course, you can have another opinion on that. Maybe you sold your shares, maybe you bought more shares. Let me know down in the comments below. I currently have not bought more shares since I bought them already last week. But if things continue this way, where the stock doesn't really move much, but the company becomes better and better, I will continue to accumulate and grow my position. Of course, as always, do share your thoughts down in the comments below. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, and I'll see you all in the next one. Bye-bye.